Rates, inventory, home values in 2024, what you need to know and what the media won't tell you. That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005. And here's the market data that you need to make an informed buying or selling decision or help your client do the same. We're going to be going into a really good year this year, but I'm not sure that the general public is going to understand that as well as we do. I say that because this is going to be a year, especially because it's an election year, in which there's going to be all sorts of craziness out there, all sorts of wacky things being said. And a lot of it is going to be about housing, because I think that housing affordability is going to be a topic of debate in the run-up to the election. So there's going to be all sorts of political figures out there saying all sorts of crazy things despite not knowing what they're talking about. We have to be able to explain that to clients so that we can help more buyers and sellers make good decisions. Buyers and sellers need to understand the relationship between mortgage rates, inventory, and home values, and how that will affect the market this year. So let's start with what, in my opinion, will be the catalyst for this year: mortgage rates. The senior economist at the Center for Economic Research said this: "It also appears that mortgage rates are now falling again. They will almost certainly not fall to pandemic lows, although we may soon see rates under 6%, which would be low by pre-Great Recession standards." Well, if mortgage rates are coming down, we also have a situation where one of the biggest challenges in the market right now is that there's not enough inventory. Part of the reason there wasn't enough inventory, or hasn't been enough inventory, is because interest rates have held most sellers hostage, meaning someone with a very low mortgage rate would be unwilling to sell if it meant taking a rate in the high sevens on the new home. But let's take a look at the brand new numbers on the rates for existing mortgages. And what we can see is that 78.7% of mortgage rates are less than 5%. That's why I say sellers are being held hostage. When rates were 7 to 8%, nobody with a mortgage rate under 5% was thinking about selling unless they absolutely had to. But with rates coming down, it will become a whole lot more palatable to surrender your low mortgage rate in the event that you need to move. I've shown you this pie chart before, and here it is again. Generally speaking, people who have less than a 3% mortgage rate are just not selling unless they really have to. Between the 3 and 4% range, they're probably not selling, but if rates get down into the 5s, they're going to start thinking about selling at least. That's where all the pent-up selling demand lives, in that section of the chart. Those listings that didn't come to the market in the last 18 months, a lot of those people still need to move. Then there's the 4 to 5% range. They will move if rates come down into the 5s, but in the meantime, they must think before selling. And then of course, there's the blue and the green, where they have mortgage rates closer to what they are now, and those people will obviously be willing to sell and move. But do mortgage rates really stand a chance of going down into the 5s this year? Well, Goldman Sachs said this: "We now forecast 3 consecutive 25 basis point cuts in March, May, and June to reset policy rate from a level that Chairman Powell has recently taken to describing as well into restrictive territory rather than just restrictive." Well, if that happens, then the market will interpret that as the inflation problem being under control, and mortgage rates will drop as a result. If we get 3 rate cuts by June, well, then we can really guarantee that it's going to be a really busy year. But it doesn't just all boil down to numbers. There's also a psychological piece to all of this. What a lot of experts and forecasters and analysts in the housing industry like to do is just look at numbers, just numbers. I would say commercial real estate is all about numbers, but residential real estate is also about people and their needs. Yes, we account for interest rates. Yes, we account for prices, also inventory. But you can't overlook the human behavior metric. This is precisely the reason why very well-educated experts and analysts on TV and major publications get it wrong, and so often. They don't really understand the human element. We, on the other hand, have our ears to the floor. We can feel the pulse of the market because we are immersed in it. We're the ones on the phone or in person with a client hearing about their needs, their pains, their desires, not the people writing sensational headlines. Let me remind you, we're in an election year. Our clients are going to hear things that are completely invalid. Remembering and feeling confident about the fact that we know more than some quack on TV is going to be really, really useful for you to keep in mind. Before we talk about home values, let's briefly talk about inventory. Here's a quote from the National Association of Home Builders. The market currently requires a high level of new construction inventory due to a persistent lack of resale inventory. Newly built homes available for sale accounted for 31% of total homes available for sale in November, compared to an approximate 12% historical average. So builders are currently contributing almost a third of all houses that sell in this country. They've gone from 12% to 31%. Now that number is obviously going to come back down as more existing resale inventory comes back to the market, but that is just another piece of evidence that supports upward pressure on prices. And speaking of prices, here is a quote from last year made by the chief economist at CoreLogic. Home price gains in the CoreLogic S&P Case-Shiller Index have increased by about 7% since the beginning of the year and are 1% higher than at the peak in 2022, recovering all the losses recorded in the second half of 2022. So remember the headlines at the end of 2022 saying that all prices are going to crash, housing is going down by 20%, and also we're never going to hit that peak again that we hit in the middle of 2022? Well, we already hit it last year. If we took a map of every single zip code in the country and we put a green dot over the zip codes where prices are up and red dots over the zip codes where prices are down, it would be a green map with a couple of red dots. So understand, as a nation, we're in much better shape than any headline will care to admit. Take a look at this data from Freddie Mac. The average annual appreciation is 4.92% over the last 42 years, and that's exactly where I think we'll end 2024, roughly 5% appreciation. Here is another quote by the chief economist at CoreLogic. With mortgage rates dropping, demand for homes in early 2024 is likely to be strong and will again put pressure on prices, similar to trends observed in early 2023. Most markets will continue to reach new home price highs over the course of 2024. So there's not going to be a crashing of prices, even though that's what you're going to hear, just like you've been hearing at the beginning of every recent year. And this year is no different. But a crash is just not going to happen. With that said, we're also not going to see 15 to 20% appreciation either. So in conclusion, helping buyers and sellers make informed decisions doesn't involve just telling them what's going to happen, but helping them understand as well. Helping them connect the dots between mortgage rates, inventory, and prices goes a long way. That's a wrap for the February market report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month. But before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.